Imagine logging into your trading account and seeing half your money gone. Your instinct tells you that a 50% return will fix it and get you back to break even. That instinct is a mathematical trap. This chart shows exactly why. Start with $10,000 and lose half. You have $5,000. Earning 50% only yields $7,500. To reach baseline, you need a 100% gain. This asymmetry of loss scales aggressively. Drop 90% and you must generate a 900% return to recover. Statisticians call this probability the risk of ruin. If you risk 10% of your capital on a single trade, a standard 5 or 6 trade losing streak leaves your account functionally dead. You won't have enough capital left to trade your way out. By hard capping your risk at 2% per trade, you create a mathematical shield. You can endure a brutal 10-trade losing streak and still have over 80% of your capital completely intact. Sticking to this 2% limit ensures that even a catastrophic run of bad luck cannot mathematically remove you from the game. It provides the longevity required for a trading edge to actually manifest in your balance. Most beginners pick a standard 0.10 or 1.00 lot size simply because it feels right, or because they saw someone else use it online. Typing in a lot size based on a gut feeling is gambling. To survive current market conditions, you have to calculate your exposure using the universal position size formula. We start with the numerator. If you have a $10,000 account and strict instructions to risk 2%, your fixed dollar risk is exactly $200. Next is the denominator. Let's say your technical analysis requires a stop-loss distance of 40 pips to be safe. You multiply those 40 pips by the standard pip value, which is usually $10 for a full lot. That gives you 400. Finally, divide your $200 risk by 400. The math dictates an exact 0.5 lot size to perfectly maintain your maximum 2% risk. Your execution sequence should always be the same. Decide where the trade is invalidated, place the stop-loss there, then calculate the lot size. Never shrink your stop-loss just to fit a bigger lot. But even a perfectly calculated stop-loss will fail if it ignores market volatility. A tight 20-pip stop might work during a quiet session, but when the market spikes aggressively, those 20 pips are essentially just background noise. You will be stopped out before the trend even begins. Professionals measure this volatility using the average true range, or ATR indicator. It measures the market's current breadth, telling you exactly how far the price typically moves in a given time frame. Instead of a static number, traders use a 1.5 or 2x ATR multiplier to widen their stop-loss distance dynamically, placing their exits safely outside the current range of volatility. Because you are running the wider stop-loss through the universal formula, the math automatically reduces the lot size to accommodate the wider gap. You give the trade room to breathe, but your total dollar risk stays completely locked at 2%. Perfect position sizing on a single trade still won't protect you if your entire portfolio is overexposed. Risking 2% on the euro and 2% on the British pound simultaneously creates an illusion of diversification. Because these pairs move in lockstep, these positions represent a single, concentrated 4% bet against the US dollar. Avoiding a catastrophic wipeout from a single news event requires zooming out. You have to monitor your total open risk across your entire portfolio, making sure your correlated exposure never exceeds that strict ceiling. The 2% rule acts as a fixed fractional growth engine. As your account grows, that 2% ceiling translates into larger dollar amounts, driving geometric growth. Conversely, it acts as a brake system. When your account drops, the fractional value shrinks, preserving your remaining capital. Humans are not naturally wired for this. When amateurs hit a drawdown, they experience an amygdala hijack, a stress response where panic sets in, and they instinctively increase their lot sizes to try and win it back in one single, heavy trade. Professionals do the exact opposite. During a drawdown, they engage in defensive scaling, actively dropping their risk ceiling down to 1%, or even 0.5%. This aggressive risk reduction protects something far more fragile than your margin balance, your psychological capital. A simple 0.5% loss is easily manageable. It allows you to keep a level head and stick to your strategy without spiraling into revenge trading. Success in the markets depends on preserving your capital through the lean periods, so you are fully prepared to capitalize on the high probability setups that follow. You can automate this math today. Download the FXNX risk management spreadsheet and use our real-time position size calculator to lock in your survival profile.